Sunil, from a broader market point of view, for long market participants and, have been critical of the government, over policy paralysis. How do you read into what has happened over the last 24 hours? About a month ago, top CEOs go and meet the Prime Minister. A committee has been set up. In about 15 days, action is taken, directed by the PMO. What kind of a signal do you think the street needs to pick up from this intervention?
One thing is that we are a democracy, and we are an actual democracy. We are not a democracy for namesake. So I think what has been done obviously has been done taking into account the nature of the country. And we can all argue that more should have been done over the last 18 months, and even we are of the view. But I think the government realizes that they have been slow. And I think the proactive steps which we are seeing from the government over the last 2 months seem to be a trend which looks likely to continue. And there are expectations that there is a possibility of the government becoming more stronger in terms of numbers as we progress over the next 2-3 months. And that might act as another, you can say, a further trigger for the government to continue with this aggressive mood, or probably even increase the speed of the much needed reforms. So I think we continue to be very, very positive, and obviously these steps which are being taken are a welcome surprise, and we are very happy about it.
Sunil, you just talked about your fund. Apart from equity diversified schemes that are available, sectoral funds like banking, natural resources, power or pharma, which of the sector funds are witnessing fresh inflows at current juncture?
As I said, I think the speed of the rally has caught all the investors by surprise, and the investors have probably not been able to participate afresh as far as fresh inflows are concerned. But one good thing is that the retail investors over the last few years have matured. So even when the things were a little bit challenging, we did not see outflows from the mutual fund. So I think long-term investors have benefited. The NAVs of most of the funds, a few of the sector funds which you mentioned, like infra, power and banking, are up like 30-35% in the last 1.5 months. They are now only marginally lower than probably their all-time peak. So I think the long-term investors have benefited. The investors who are waiting for a right opportunity have missed the last 15-20% up move. But for a long-term investor, probably that is nothing to be worried about. And our view would be that whenever you get an opportunity, or whenever you share the optimism from a longer-term perspective, or whenever there are a few triggers which are definitely going to hit the market in the next few months, I think it's still not too late.
Sunil, you sounded pretty bullish on the long term as far as Indian market is concerned, but what about the year-end Sensex target? Because now already we see several market participants push their targets to as high as 22,000. What kind of level are you watching out for the Sensex by December 2012?
I'll be very candid and admit that even we have been completely taken by surprise by the intensity of the rally. And if you would have asked anyone their long-term their year-end target in December, it would not have been more than 16,000-17,000. We are already at 18,000 1 month into the year. Again, we don't have any targets. Neither do we believe that the targets ultimately pan out to be what you expect. But I think this rally has been very swift. Probably there is a view that we might take a pause. It is possible. We might probably react by a few percentage points here. But the difference in the mood is very, very evident. So from a mood where people were waiting for the markets to go up to sell, I think we have clearly a mood, whether it is domestic investors or global investors, that they're all looking at opportunities of a small reaction coming in the market to invest big time. And I think that will ensure that the market stays stable in the near term. As far as the year end is concerned, as I said, a lot has been done from the government and policy front. We still need a few more steps over the next few months. And I think if these steps keep on coming, there is definitely a possibility of the markets moving up further. On the macroeconomic front, inflation again is below 7%, much sooner than what most people expected. And there is an expectation that, and there is a need for substantial easing as far as liquidity and interest rates in the country is concerned. And I think if that continues to happen, again, that would be another trigger. So I think without biting the bullet and giving you a target, our view would be that keep on watching the small steps which are going to be taken probably and hopefully in the next few months. And you might end up seeing a market which is quite decent.
Sunil, however, what do you think is going to turn out with the budget as an event? And can we expect the government to deliver this time around, or do you think this is going to be a non-event, as has been the case in the past as well, when the market just reacts for one day and then moves on?
It's, over the last, as you rightly mentioned, over the last 2-3 years, budget is becoming less and less relevant from a market perspective, because it is more now, a statement on the overall broad macroeconomy, rather than earlier when you had huge excise and customs duty and a lot of companies used to get impacted by reduction or increase in those. However, as you said, this time I think the finance minister obviously has a task at hand. It is a difficult budget to present. We are still, as a country, facing the problems of a huge fiscal deficit, definitely a problem on the current account deficit, and also the finance minister needs resources through disinvestment, through some other means to bridge this gap. I think this budget, from a market perspective, is again going to look more from a policy front going forward. So whether it is tackling of the subsidy burden, or mentioning some steps which can long term address these issues of subsidy as well as current account and the fiscal discipline. So I think it's more going to be you can say, a policy statement which is going to be awaited. But from a finance minister perspective, I think it's definitely a difficult budget to present.
It is a difficult budget to present, but Sunil, you don't seem too worried by the overall macro environment. But the fact of the matter is that we're probably going to be staring at a fiscal deficit of 5.5%. That's a good 1% over what was budgeted for, and it's unlikely that we'll be anywhere under 5% for FY13 as well. The divestment target of 40,000 crores is not going to be met. That's pretty clear as well. Are you not concerned by the macro factors that are at play right now?
No, I fully agree with you. We are bullish on the market front. We are definitely concerned about all the numbers which you mentioned. But the fact of the matter is that 99 out of 100 people in the streets are concerned about it and are already discounting that fact. And I think from that perspective, unless it is significantly higher from the numbers which we are already expecting, I don't think it is going to impact that much as far as the equity markets are concerned. The other thing is fiscal deficit in 1 year shooting up to 5.5% is fine, as long as you have a clear-cut, you can say a roadmap of how you are going to bring it back on track. And that is where I said, the policy statements from a longer-term perspective are going to be more important as far as this budget is concerned. US had a fiscal deficit of as high as 9% in 2008-9 because that was the need of the hour. And now, as you see, the unemployment there has fallen from 10 to 8%. The markets are at 10 years, 11 years high. So I think all that is taken care of as long as you have discounted the worst, and there is a clear roadmap that this worst is the worst, and from here on there is only going to be improvement. So I think the markets are looking at that perspective rather than the number of fiscal deficit being at 5.5 or 5.4 or 5.6.
Sunil, so what's the nifty base that you're working at, considering you do feel that it's not going to be just a one-way rally up for the market this year, and we may see pause or corrections as well in the near term? Is 4,500 the clear base, or do you think we could drift lower?
Again, I don't have an answer to it. What I can say is, at the cost of repetition, is that for a change now, we have investors who are looking at the minutest of minutest, reaction to pump in huge sums of money. And I think that would ensure that that reactions, if any, are going to be swift and short. And probably at least this view for the near term should hold. Again, it's a very, very dynamic situation. We are going wrong almost on a daily basis, and that is true probably for most of the market participants. But from our perspective as institutional investors managing funds for 7 million investors, we are more or less fully invested. As we speak, we are trying to see where there is value, where stocks have moved up too fast given their current and the prospective fundamentals, and whether there is an opportunity to sort of jig our portfolio wherever possible. And I think that is where the whole effort is. And luckily, probably we have been able to create a significant alpha. And we are very, very sure that investors who have not made any money from the equity market for the last 2-3 years, probably, if things work out, there is a very good chance that over the next 2 years, equity would again sort of become the numero uno as far as returns on the asset classes are concerned.
Sunil, my final question in this entire conversation, we've completely discounted one piece, and that's Europe. Do you think it's about time our markets also begin to discount Europe?
Europe is a fluid situation. Again, Europe has been discounted by the market at least 100 times. Our call is very, very clear. If someone has spent more money than what they have earned, they will have to bear the consequences of it. So I think the sooner they bear the consequences, the better. I think every day we hear that Greece is agreed to the package, the markets go up. There is now news that Greece has not agreed to the package, the markets go down. So we have no control on what is going to happen and whether Greece is going to agree or not agree. So from our perspective, we believe that we have to definitely look at Europe as a sort of a problem area or a likely problem area. But the signals which we are getting from speaking to renowned economists who track Europe very closely is that in the near term, things will be taken care of. So you might have some interim volatility depending on what happens immediately to Greece and Portugal. But I think at least in the near term, the larger countries are well taken care of. The sort of, the QE indirectly which has happened in the Europe has ensured that countries like Spain and Italy have been able to raise significant sums through auction of government bonds at lower than the expected yields. And I think that has given the market confidence. And one reason for this huge rally in risk assets globally has also been to the fact that Europe now looks to be a much smaller problem than earlier envisaged.
Okay, Sunil, good to have you on the show. Appreciate you taking the time out and joining us this afternoon.